The biggest investing mistake isn't buying the wrong ETF. It's spending years trying to figure out which ETF to buy before ever starting. And that's exactly where millions of people are stuck right now. There's a specific kind of paralysis that happens the moment someone decides they should probably start investing. You open an app or a website, and within about 90 seconds, you're staring at a wall of terms that nobody ever sat you down and explained. Index funds, expense ratios, Roth versus traditional, asset allocation, bull markets, diversification. None of it is inherently that complicated, but all of it arriving at once, with real money on the line and a fear of doing it wrong, is enough to make most people close the app and tell themselves they'll figure it out later. Later usually never comes, not because people don't care about their future, but because figure out investing feels like a project with no clear starting line, and projects with no clear starting line are exactly the ones that get pushed indefinitely. Before we go any further, if you're the kind of person trying to make sense of money without anyone ever having handed you a roadmap, this is exactly what this channel is built for. Taking the stuff that sounds complicated and actually explaining it, plainly, the way it should have been explained the first time. If that's useful to you, subscribing just means you'll have this in your corner the next time something in your financial life needs a translator. Here's what today actually is. This isn't a quick overview. This is the full thing. Everything you'd need to understand to go from having never invested a dollar to genuinely knowing what you're doing, why you're doing it, and how to actually execute it. We're going to cover why investing matters in the first place, how the different investment types actually work, which accounts exist and when to use each one, how to think about choosing a brokerage, whether your money is actually safe, what to actually buy and why, how to build a real first portfolio, how much to invest at different income levels, what actually happens mechanically when you place your first trade, how taxes work on all of this, the mistakes that quietly wreck beginners, and the philosophy that separates people who build wealth from people who just talk about it. By the end, you should be able to open an account this week and know exactly what to do. Let's start with the most basic question, because skipping it is exactly why so many people never build the motivation to follow through. Why can't you just save your way to financial security instead of dealing with any of this? Here's the problem with saving alone. Every dollar you keep in cash is quietly losing value over time, even while the number on the screen stays the same or grows slightly. This is inflation, prices rising over time, which means the same dollar buys a little less next year than it does today. Historically, inflation has averaged somewhere around 2 to 3% a year, though it fluctuates, sometimes significantly. If your money is sitting in a savings account earning less than that rate, you're not actually preserving your wealth. You're watching it shrink in real terms, just slowly enough that it doesn't feel like it's happening. This is where opportunity cost comes in, and it's a concept worth understanding deeply because it applies to nearly every financial decision you'll ever make, not just investing. Every dollar you choose to do one thing with is a dollar you're simultaneously choosing not to do something else with. Money sitting in a savings account earning 1% isn't neutral. It's actively costing you the difference between that 1% and whatever it could have earned somewhere else. Historically, the stock market has returned closer to 10% annually on average over long periods. That gap, compounded over decades, is enormous, which is why just saving isn't actually a safe, conservative choice in the long run. It's a choice that guarantees you miss out on the vast majority of the growth available to you. Here's why investing isn't the same thing as gambling, despite how often people conflate the two. Gambling involves a negative expected return. The odds are structured so that, on average, the house wins and the player loses, and there's no underlying productive asset generating value. Investing in a broad selection of companies, by contrast, is a bet on productive economic activity continuing to happen. This is also exactly why wealthy people, almost universally, invest rather than simply accumulate cash. not because they have access to some secret opportunity, but because they understand that cash sitting still is a losing position over any meaningful stretch of time. Okay, so now you understand why investing matters. But knowing you should invest and knowing what you're actually buying are two completely different problems, and this is usually where people get stuck next. Let's try something. Imagine I hand you $10,000 and give you three choices for what to do with it. Choice 1. You put the entire $10,000 into a single company. Let's say you buy shares of Apple. That's it. That's the whole choice. Now your $10,000 is tied entirely to one company's fate. If Apple has a great year, you do well. If Apple stumbles, a bad product launch, new competition, a leadership shakeup, your $10,000 stumbles right along with it. This is what buying an individual stock actually means. You own a small piece of one business, and your outcome depends entirely on that one business. Choice 2. Instead of picking one company, I take your $10,000 and buy you a tiny sliver of 500 different companies at once. A little bit of Apple, a little bit of Microsoft, a little bit of Amazon, Costco, Visa, Coca-Cola, Johnson & Johnson, and 493 others. Now, if Apple has a terrible year, it's a small fraction of your $10,000, barely felt. If several of the others have a great year, your $10,000 benefits from all of them at once. Which of these two choices sounds safer to actually hold on to for the next 20 years? That second option is what's called an ETF, an exchange-traded fund, a single investment that holds many companies bundled together and trades throughout the day just like a regular stock. Here's where it gets simpler, not more complicated. Many ETFs don't have a person manually deciding which companies to include. They just copy a predefined list of companies, say the 500 largest in the country. That predefined list is called an index. And an ETF that simply copies an index rather than having someone handpick the companies is called an index fund. So ETF and index fund aren't two separate things to memorize. An index fund is just a specific, simpler kind of ETF, one that follows a list instead of a person's judgment. Now, choice 3. Some people don't want a computer mechanically copying a list. They want an actual professional, a fund manager, actively choosing which companies to include, trying to beat what that plain list would have done on its own. That's called a mutual fund. It's a similar idea to an ETF. Many companies bundled into one investment, but with a person actively picking instead of a fixed list, and usually with higher fees as a result, since you're paying for that person's judgment. There's one more option worth knowing, and it's a completely different category. Instead of buying a piece of any company at all, you could lend your money out instead to a government or a corporation in exchange for regular interest payments and your original amount back later. That's a bond. You're not betting on a company's success anymore. You're just being paid for the loan at a lower but far more predictable rate than owning companies typically offers. So that's really it at the core. Stocks, where you own one company and ride its outcome directly. ETFs, where you own a bundle of many companies at once. Index funds, which are simply ETFs that copy a fixed list instead of relying on a person's picks. And bonds, where you're lending money out instead of owning anything at all. Everything else you'll hear about, real estate funds, cash-like funds, dividend-focused funds, are variations and combinations of these same four ideas, and we'll get to a couple of them later, exactly when they actually become relevant, instead of all at once right now. Now you know what you'd actually be buying. But here's the thing that trips people up next. And it's not the investment itself. It's figuring out where to hold it. Here's the simplest way to think about this. Imagine your investments, the ETFs, the index funds, all of it, as things you can put inside different containers. The investment itself doesn't really change based on which container it's in. What changes is how the government taxes it. So the real question isn't, what is a 401k or what is a Roth IRA as separate topics to memorize. It's just, which container should your next dollar go into first? Here's the order that makes sense for most people, step by step. Step 1. Does your employer offer a 401k match? If they do, this is where your money goes first, before anywhere else. Imagine your employer saying, for every dollar you put in, I'll add another dollar. That's an immediate 100% return before your money has even touched the market. It's about as close to free money as personal finance ever gets, and passing it up is passing up money that's already yours. Step 2. Open a Roth IRA. Once you've captured the full match, this is usually the next stop. You contribute money you've already paid taxes on, and in exchange, it grows for decades completely tax-free. No taxes owed at all when you eventually withdraw it in retirement. For someone early in their career, this is one of the most powerful tools available, precisely because you're paying taxes now while you're likely earning less than you will later. Step 3. Go back and increase your 401k contributions beyond just the match if your budget allows for it. Step 4. A brokerage account. If you've maxed out the accounts above, or you're investing for something before retirement, a house down payment 10 years out, for example, a regular brokerage account gives you complete flexibility. No contribution limits, no age restrictions on withdrawals. The trade-off is that you'll pay taxes on any gains along the way, which is exactly why it comes after the accounts that offer tax advantages, not before. There are a couple of other containers worth knowing exist, briefly. An HSA, a health savings account, offers a genuinely unique triple tax advantage if you qualify through a high-deductible health insurance plan. A 529 plan is designed specifically for education savings. Both are excellent tools in the right situation, but for most beginners, your biggest priorities are the 4 steps above: the employer match, a Roth IRA, increasing your 401k, and a brokerage account for anything beyond that. You'll also sometimes hear about traditional IRAs, which work similarly to a Roth but flip the tax timing. A deduction now, taxes later, instead of the other way around. It's a legitimate account, but to keep this focused on what most new investors actually need first, the 4 steps above are the ones worth acting on today. So if you got paid today and you're wondering where that money should actually go, that's your answer. Match first, Roth IRA second, back to the 401k third, brokerage account for whatever's left after that. Now let's talk about where you actually open one of these, because I want to save you a headache here. The good news is that choosing a brokerage is probably the easiest decision you'll make in this entire video. Most major brokerages are safe, regulated, and perfectly capable of helping you build real wealth. The differences between them matter far less than people make them seem, so let's not turn this into another thing to agonize over. If I were recommending one platform to a complete beginner today, it would be Fidelity. It's easy to use, offers strong customer support, allows you to buy fractional shares, has excellent retirement account options, and gives you access to virtually everything you'll need, all in one place. Vanguard is the other one worth knowing. It's the platform that essentially pioneered low-cost index investing, and it remains a fantastic choice, especially if you're planning to invest primarily in broad index funds for decades, which is exactly what most of this video has been building toward. The app itself is a little less polished than Fidelity's, but the actual investing experience is excellent. Honestly, if you choose either Fidelity or Vanguard, you're in a great place. There are other platforms out there too: Charles Schwab, Robinhood, Public, Webull, M1 Finance, and many of them are perfectly good. But spending hours comparing 6 platforms isn't the best use of your time as a beginner. Pick one of the 2 above and move on to the part that actually matters. Now, before we go further, let's address the question that's probably sitting underneath all of this, even if it hasn't been said out loud yet. Is your money actually safe with any of these companies? Here's the honest answer. Brokerage accounts in the U.S. are covered by something called SIPS insurance, which protects your investments up to certain limits if the brokerage itself were to fail or go out of business. This is similar in spirit to how FDIC insurance protects money in a bank account, except it's specifically designed for investment accounts rather than cash deposits. This doesn't protect you from your investments losing value. That's a normal, expected part of investing, and no insurance covers ordinary market ups and downs. What it protects against is the brokerage itself disappearing with your holdings, which is a much rarer and different kind of risk. It's also worth understanding that when you buy a share of VOO or any other fund through Fidelity or Vanguard, that share isn't Fidelity's or Vanguard's property, sitting in some pool the company controls. It's legally yours, held in your name, in what's called a custodial arrangement. If Fidelity, hypothetically, went out of business tomorrow, your shares don't vanish along with it. They'd typically be transferred to another custodian, and you'd retain ownership the entire time. The brokerage is essentially just the platform you're using to hold and manage investments that are legally yours, regardless of what happens to the company providing the platform. This is genuinely one of the more reassuring facts in all of investing, and it's rarely explained clearly, which is exactly why it tends to sit in the back of people's minds as a vague, unresolved worry instead of a settled question. At this point, you already know more than most people do before they ever open their first investment account. Now let's answer the question that actually stops most people from clicking the buy button. What should you actually be buying? Individual stocks require you to pick specific companies, which means your results depend entirely on those specific choices being correct. ETFs and index funds, by contrast, spread your money across many companies at once. Target date funds are a specific type of fund designed to automatically adjust its mix of stocks and bonds as you approach a target retirement year, becoming more conservative over time without you needing to manually rebalance anything yourself. A genuinely useful, low-effort option for someone who wants a fully hands-off approach. For risk and return, individual stocks carry the highest potential for both dramatic gains and dramatic losses. Broad index funds carry meaningfully less risk because of diversification, while still capturing the overall growth of the market. Bonds carry the least risk of the categories discussed here, but also the lowest expected long-term return. Fees matter more than people initially assume. A fund charging 1% annually versus one charging 0.03% annually might sound like a small difference, but compounded over decades, that gap can cost you tens of thousands of dollars in what would otherwise have been growth. Let's get specific about the fund names you'll actually run into, because hearing ticker symbols thrown around without context is part of what makes this feel like a foreign language. If you're completely new, you really only need to know one thing to get started. Something broad, like VO or VTI, is a completely reasonable place to begin. VOO tracks the S&P 500, meaning it holds the 500 largest publicly traded U.S. companies, weighted by size, broad, simple, low-cost exposure to the U.S. economy's biggest, most established businesses in a single purchase. VTI is similar but slightly broader, tracking essentially the entire U.S. stock market, including small and mid-sized companies alongside the large ones VOO holds. Either one, on its own, is a genuinely complete first investment. You don't need anything else to start. As you learn more and want to build the picture out further, there are a few other funds worth knowing exist, though none of them are necessary on day one. VIXIS adds exposure to international stocks outside the United States, for when you want your portfolio to reflect more than just one country's economy. BND is a broad U.S. bond fund, used to add stability once you want to dial back some volatility. QQQM leans heavily into technology and growth companies, offering higher potential growth alongside higher volatility. She focuses specifically on dividend-paying companies, appealing to investors who want a mix of growth and regular income. None of these are required reading for a first purchase. They're the next layer, for later, once VOO or VTI has gotten you off zero and the basics feel comfortable. Let's build a few example portfolios so these building blocks feel concrete instead of abstract. For someone in their mid-20s with decades until retirement, a portfolio of 100% VOO is a reasonable, simple, aggressive growth approach, accepting full stock market volatility in exchange for the potential for strong long-term growth. A slightly more diversified version might be 80% VOO and 20% VXIS, adding international exposure so the entire portfolio isn't dependent on a single country's economic performance. For someone who wants a bit more balance, a portfolio of 70% VTI, 20% VXIS, and 10% BND adds a small bond allocation for stability. This is also where it's worth mentioning one more category now that diversification is actually the topic: REITs, short for real estate investment trusts. These are funds that own income-producing real estate, office buildings, apartments, shopping centers, and are required to distribute most of their profits to shareholders as dividends. Some investors add a small REIT allocation to a portfolio, like the ones above, specifically to gain real estate exposure without needing to buy property or become a landlord themselves. It's not essential for a first portfolio, but it's a common next layer once the core stock and bond allocation is already in place. None of these example portfolios are the single correct answer. They're reasonable starting points that illustrate how these pieces combine. Now let's pause on something, because I've thrown a lot of information at you, and if a specific fear has been quietly building in the back of your mind this whole time, you're not alone, and it deserves a direct answer instead of being brushed past. What if you buy today and the market crashes tomorrow? Here's the honest answer: it might. Markets go down, sometimes sharply, and there's no way to know in advance when that will happen. But if you're investing for a genuinely long timeline, years, not months, a short-term crash the week after you start is largely irrelevant to your eventual outcome because you're not planning to touch that money for decades. The mistake isn't buying before a downturn. The mistake is panicking and selling during one. What if you choose the wrong ETF? For a beginner using a simple, broad, low-cost fund like VOO or VTI, there really isn't a wrong choice in any catastrophic sense. These funds are similar enough that the difference between them is a matter of fine-tuning, not a make-or-break decision. You can always adjust your allocation later as you learn more. Nothing about your first fund choice is permanent. What if another fund performs better than the one you picked? Something almost certainly will, in any given year. That's true no matter what you choose. Chasing whichever fund performed best last year is actually one of the more common ways beginners hurt their own returns, because past performance in any single year says very little about future performance. The goal was never to pick the single best performing fund. It was to pick a reasonable, diversified fund and stay in it consistently. What if you're too late? What if everyone who was going to make money from investing already has? This one comes up constantly. And it's understandable, but it misunderstands how this actually works. The market has grown over almost every extended period in history, through wars, recessions, and crises that, at the time, felt like they might be permanent. Someone starting today is not meaningfully late compared to someone who started 5 years ago in the context of a multi-decade investing timeline. The person who's actually behind isn't the one starting today. It's the one who waits another 5 years to start because they felt like they'd already missed it. Okay, let's get practical again. Let's talk about how much to actually invest, because invest consistently is meaningless advice without a real number attached to it. Dollar cost averaging means investing a fixed amount on a regular schedule, regardless of what the market is doing that particular day or week. The practical version of this is automatic investing. Setting up a recurring transfer from your bank account into your investment account, timed to your paycheck, so the decision only has to be made once instead of being relitigated every single month. This connects directly to the idea of paying yourself first, treating your investment contribution like a non-negotiable bill, moved out before you have the chance to spend it on something else. This is also a good moment to mention one more type of fund, since it's specifically relevant to how you manage the cash you're not ready to invest yet: a money market fund. This is a very low-risk, cash-like investment closer in spirit to a high-yield savings account than to stocks or bonds. If you've got money set aside that you're planning to invest soon but haven't yet, or cash you want earning something while it waits, this is generally a better home for it than letting it sit in a regular checking account earning nothing. In terms of actual amounts, here's a reasonable framework across different income levels. On a $40,000 income, contributing enough to capture any employer match, even if that's the only contribution happening initially, is a completely reasonable starting point. On a $60,000 income, aiming for somewhere around 10 to 15% of income going toward investing, once basic expenses and an emergency fund are handled, becomes more realistic. On an $80,000 income, that percentage can often stretch toward 15 to 20%. On a $120,000 income, many people have enough margin to push toward 20% or more, especially once they've maxed out tax-advantaged accounts and have room left over for a taxable brokerage account as well. These numbers are directional, not absolute. Let's walk through what actually happens mechanically when you place your first trade, because this exact moment is where a lot of beginners freeze up. After opening an account, you transfer money in from your bank account, which typically takes a few business days to fully settle. Once the funds are available, you search for the specific fund you want, typing in the ticker symbol, something like VOO. You'll choose an order type, and for a beginner, a market order is the simplest option, buying at the current market price immediately. You'll enter either a dollar amount or a number of shares. If your brokerage supports fractional shares, which most major ones now do, you can invest an exact dollar amount, like $50, even if one full share costs more than that. You confirm the purchase, and that's it. The trade executes, typically within seconds during market hours. It genuinely is that simple. Mechanically, even though the anxiety beforehand often makes it feel like it should be more complicated than it is. Now let's talk about taxes, briefly, because beginners either ignore this completely or overcomplicate it. When you sell an investment for more than you paid, that profit is a capital gain, and it's taxable, at your regular income rate if you held it a year or less, at a lower rate if you held it longer, which is one of the clearest incentives in the tax code to hold long-term rather than trade frequently. Qualified dividends generally get that same lower rate. Inside tax-advantaged accounts like a 401k, IRA, or HSA, none of this matters day to day. Gains aren't taxed as they happen. In a taxable account, these rules apply every year. There's a more advanced strategy called tax loss harvesting, worth knowing exists, but it's not something a beginner needs to act on today. That's a topic for later, once your portfolio has grown into something more complex. Let's talk about the mistakes that quietly wreck beginner investors. Waiting for the right time to start is the single most common one. Trying to pick individual stocks before understanding the basics tends to concentrate risk in ways beginners don't fully appreciate until something goes wrong. Watching financial news constantly creates a false sense that you need to react to every headline. Checking your portfolio daily measurably increases the likelihood of emotional, damaging decisions. Trying to time the market has been shown repeatedly to underperform simply staying invested consistently. Buying speculative, hyped investments based on social media trends rather than research is one of the fastest ways to lose money as a beginner. Using margin, which means borrowing money to invest more than you actually have, dramatically amplifies both potential gains and potential losses, and is generally inappropriate for beginners. Panic selling during a downturn locks in losses that would very likely have recovered had the investment simply been left alone. And trying to get rich quickly, rather than accepting that this is fundamentally a decades-long process, leads people toward exactly the kind of risky, speculative behavior most likely to actually cost them money. Before we close, here's what I wish someone had told me plainly, instead of leaving me to piece it together over time. You don't need thousands of dollars to start. Most brokerages let you begin with a few dollars through fractional shares, and the amount matters far less than the decision to actually begin. Your first investment doesn't need to be perfect. It needs to exist, so the clock starts. The first $100 you invest matters more than the second 100, not because of the dollar amount itself, but because it's the one that gets you off zero and into the habit. Ignore financial influencers promising quick riches through some secret strategy. If it actually worked reliably, it wouldn't need to be sold to you as a secret. And wealth, while you're actually building it, usually feels boring. Not thrilling, not dramatic, just a quiet, repeating decision made the same way, month after month, that doesn't feel like much of anything until, years later, it very clearly was. Here's the philosophy underneath all of this, and it's worth internalizing because it will serve you for the rest of your investing life. Investing, done correctly, is not exciting. Boring, consistent, unremarkable behavior has historically outperformed exciting, active, attention-grabbing behavior by a wide margin for the vast majority of investors. Consistency beats intelligence in this specific arena more often than people expect. Time in the market matters more than timing the market. Wealth built through investing is built over decades, not months. You do not need to beat the market. You need to stay in the market, not outsmart it, not time it perfectly, just remain invested, consistently, for long enough that compounding has the time it needs to do the actual work. If today is the first day investing finally made sense, don't let it become another video you watched and forgot. Open your account this week. Invest your first dollar, because years from now, you won't remember the day the market went up 2%. You'll remember the day you finally got started.